My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject International Business as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is: define mercantilism in international trade. Mercantilism is one of the oldest trade theories, 16th, 18th century, that says a country's strength comes from collecting gold and silver. To become rich, a country should export more goods than it imports. The idea was that selling products to other countries brings money in, while buying from them sends money out. Mercantilist countries encouraged industries, controlled colonies for raw materials, and used trade restrictions like high import taxes to protect local businesses. Example: Britain followed mercantilism during the colonial period. It imported cotton from India at cheap rates, manufactured clothes in Britain, and sold them back to India at higher prices. This way, Britain gained wealth and power. Easy way to remember. Think of mercantilism as money in, nothing out, always earning more than spending. Though outdated today, mercantilism shaped early global trade policies and helped European nations grow rich and powerful. Next important short question is: 2. What is foreign direct investment, FDI? Foreign direct investment, FDI, means when a company or person from one country invests money in another country to run a business there. Instead of just buying shares, the investor controls or manages the business. FDI can be done by building factories, offices, or infrastructure in another country, greenfield investment, or by buying an existing company, merger and acquisition. Example: Walmart, USA, invested in Flipkart, India, buying a big share and helping Flipkart grow. This is FDI because Walmart owns and manages part of the company, not just buying stocks. Why it's important? Brings foreign money, jobs, and technology. Helps the local economy grow. Creates global business connections. Easy way to remember. Think of FDI as foreign money coming in with control, not just lending, but actively managing and growing business in another country. Next important short question is: 3. Explain the product life cycle theory in brief. The product life cycle theory explains how a product moves through different stages in the market, from its creation to its decline. It has 4 main stages. 1. Introduction. The product is launched, marketing costs are high, and sales are low. 2. Growth. Sales increase quickly, competitors may enter. 3. Maturity. Sales reach the highest level, competition is strong, and prices may drop. 4. Decline. Sales fall because of new products or changing trends. Example: think of Nokia phones. Introduction: when Nokia first launched mobile phones. Growth: sales boomed worldwide. Maturity: Nokia became a market leader. Decline: smartphones like iPhones and Androids replaced it. Easy way to remember. IGMD: intro, growth, maturity, decline. Like a human life: birth, youth, adulthood, old age. PLC helps companies plan marketing, pricing, and innovation strategies. Next Unit 2. Long questions. First important long question is: 1. Compare and contrast absolute advantage and comparative advantage theories with examples. Absolute advantage versus comparative advantage theories. International trade theories explain why countries trade with each other. Two important theories are absolute advantage and comparative advantage. 1. Absolute advantage. Adam Smith, 1776. A country has an absolute advantage if it can produce a product more efficiently than another country, using fewer resources or less time. Example: India can produce textiles faster than some countries. USA can produce computers faster than India. So, India focuses on textiles and USA on computers, benefiting both. Key point: absolute advantage focuses on productivity and efficiency. 2. Comparative advantage. David Ricardo, 1817. A country has a comparative advantage if it can produce a product at a lower opportunity cost than another country, even if it is less efficient overall. Example: suppose India is less efficient in producing both textiles and cars than USA. But India loses less by making textiles than by making cars. USA loses less by making cars than by making textiles. So, India produces textiles, USA produces cars, and both trade. Key point: comparative advantage focuses on opportunity cost, not absolute productivity. Comparison table. Feature: absolute advantage, comparative advantage. Focus: efficiency and productivity, opportunity cost. Trade decision: produce what you are best at, produce what you are relatively better at. Basis: quantity of resources used, foregone alternatives. Example: India, textiles, USA, computers. India, textiles, USA, cars, even if USA is efficient in both. Easy way to remember. Absolute advantage: who is better at making it. Comparative advantage: who loses less by making it. Conclusion: absolute advantage explains trade based on efficiency, while comparative advantage explains trade based on relative benefits. Both theories help countries specialize, reduce costs, and gain from international trade. Next important long question is: to explain the factor endowment theory and its role in international trade. Factor endowment theory and its role in international trade. The factor endowment theory, also called the Hex-Caroline theory, explains how countries trade based on their resources. It was developed by Eli Heckscher and Bertil Ohlin. Concept of factor endowment. A country's factor endowment refers to the resources it has in abundance, such as land, fertile land, minerals; labor, skilled or unskilled workers; capital, money, machinery, infrastructure. The theory states that a country will export goods that use its abundant resources and import goods that use its scarce resources. This helps countries benefit from their natural and human resources. Example: India has abundant labor but limited capital. So, India exports textiles and garments, labor-intensive goods. USA has abundant capital but less cheap labor. So, USA exports machines and high-tech products, capital-intensive goods. This way, each country specializes in products that use their resources efficiently, which increases productivity and reduces costs. Role in international trade. 1. Explains trade patterns, helps understand why some countries export labor-intensive goods and others capital-intensive goods. 2. Promotes specialization, countries focus on what they can produce best based on resources. 3. Reduces production costs, efficient use of abundant resources lowers costs, making exports competitive. 4. Supports economic growth, encourages trade, investment, and better use of natural and human resources. Easy way to remember. Abundant resources export goods using them. Scarce resources import goods using them. Conclusion. The factor endowment theory shows that resources determine trade patterns. Countries benefit by exporting products that use their abundant factors and importing products that use their scarce factors. This leads to efficient global trade, higher productivity, and economic development. Next important long question is 3. Discuss modern trade theories, country similarity, new trade cycle, national competitive advantage in detail. Modern trade theories. Modern trade theories help explain international trade in today's world, where technology, competition, and innovation play a big role. The main modern theories include country similarity theory, new trade theory, and national competitive advantage, Porter's diamond. 1. Country similarity theory. Proposed by Linder, this theory says that countries with similar income levels and consumer preferences trade more with each other. Example, India and China both produce and trade smartphones and clothing for similar income groups. People prefer products from countries that understand their needs, so similar countries trade similar products. 2. New trade theory. Developed by Paul Krugman, this theory emphasizes economies of scale and first-mover advantages. Countries can specialize in certain products, even if they don't have a huge resource advantage, because producing in large quantities reduces costs. Example, South Korea became a major exporter of cars and electronics by producing large volumes efficiently. This theory also explains why a few countries dominate high-tech industries. 3. National competitive advantage, Porter's diamond. Proposed by Michael Porter, this theory explains why some countries succeed in certain industries. The diamond has 4 key factors. 1. Factor conditions, skilled labor, technology, and infrastructure. 2. Demand conditions, local demand for products encourages innovation. 3. Related and supporting industries, strong suppliers and partners. 4. Firm strategy, structure, and rivalry, competition pushes firms to improve. Example, Germany's success in automobiles comes from skilled workers, strong suppliers, high domestic demand, and global competition. Importance of modern trade theories. 1. Help understand trade patterns in similar countries. 2. Explain role of technology and economies of scale. 3. Guide governments and firms to improve competitiveness. 4. Show why innovation, strategy, and local conditions affect global trade success. Easy way to remember. Similarity trade with like-minded countries. Scale large production reduces costs. Diamond local factors create global champions. Conclusion. Modern trade theories focus on technology, competition, and specialization, helping countries and firms compete successfully in global markets. Next important long question is 4. Explain the trends, growth, and challenges of India's foreign trade. Trends, growth, and challenges of India's foreign trade. India's foreign trade has grown rapidly over the last few decades, becoming a key driver of economic development. It involves exports, selling goods, services abroad, and imports, buying from other countries. 1. Trends in India's foreign trade. Diversification of exports. India exports IT services, textiles, pharmaceuticals, and engineering goods. Global markets. Main trade partners include USA, UAE, China, and European countries. Service-led trade growth. India's IT and software services contribute significantly to exports. Increase in bilateral and regional trade agreements to boost trade opportunities. Example, The rise of Indian IT giants like TCS and Infosys has made services exports a global success. 2. Growth of India's foreign trade. India's exports and imports have increased steadily due to globalization and economic reforms since 1991. Export growth, from traditional goods like textiles to modern products like electronics and software. Import growth includes crude oil, machinery, gold, and electronics, which support domestic industries. Trade to GDP ratio. India's trade contributes significantly to its economic growth and foreign exchange earnings. Example, India exports rice and software and imports crude oil and gold, balancing domestic needs with global demand. 3. Challenges in India's foreign trade. 1. Trade deficit. Imports often exceed exports, especially crude oil and electronics. 2. Global competition. Indian products face tough competition from China, USA, and European countries. 3. Infrastructure gaps. Ports, roads, and logistics can slow down trade efficiency. 4. Currency fluctuations. Variations in exchange rates affect export competitiveness. 5. Regulatory barriers. Tariffs and global trade policies sometimes limit market access. Easy way to remember. Trends: diversification and services. Growth: increased exports and imports. Challenges: deficit, competition, infrastructure, currency, regulations. Conclusion: India's foreign trade is expanding and diversifying, contributing to economic growth. However, challenges like competition, trade deficit, and infrastructure must be addressed for sustained global success. Next important long question is: 5. Describe the structure and importance of balance of payments, BOP, with its components. Balance of payments, BOP structure and importance. The balance of payments, BOP, is a systematic record of all economic transactions between a country and the rest of the world during a specific period, usually a year. It shows how money flows in, credits, and out, debits, of the country. Structure of BOP. BOP has 3 main components. 1. Current account. Records trade in goods and services, income, and current transfers. Goods, exports and imports of physical products like rice, electronics. Services, IT services, tourism, shipping. Income, earnings from investments abroad like dividends. Transfers, foreign aid, remittances from NRIs. Example, India's IT exports to the USA appear as credit in the current account. 2. Capital account. Records capital transfers and acquisition disposal of non-financial assets. Includes debt forgiveness, grants for infrastructure, and transfer of ownership of assets. Example, a foreign company giving India a grant for building a highway. 3. Financial account. Records investment flows, including foreign direct investment, FDI, portfolio investment, and loans. Shows how money moves for buying or selling assets. Example, a Japanese company investing in a new factory in India is recorded as FDI. Importance of BOP. 1. Economic health indicator, shows whether a country earns more than it spends abroad. 2. Policy guidance, helps the government decide exchange rate, trade, and monetary policies. 3. Attracting investment, a healthy BOP encourages foreign investors. 4. Identifying deficits, helps manage trade deficits or capital shortages. 5. International credibility, countries with stable BOP are trusted in global markets. Easy way to remember. Current account trade and services. Capital account grants and asset transfers. Financial account investments and loans. BOP shows all money flows in and out and guides economic decisions. Conclusion. BOP is a vital tool for understanding a country's external economic position. A strong and balanced BOP ensures economic stability, investor confidence, and sustainable international trade.